My name is Leif Nilsson, CEO of SURG Copper. My background, physicist originally, spent some time doing work in the mining space as a exploration geophysicist before transitioning into corporate finance, and then spent about 15 years as a mergers and acquisition banker for a range of different big financial institutions around the world, predominantly with Macquarie Capital. Got involved in SURG about 5 years ago, concurrently with the company's acquisition of the Berg project, which is now our flagship asset, which is what I'll be focusing the discussion on. This photo on our cover page here is a picture of the Berg deposit. As you can see, it's a huge, multi-billion-ton deposit. Everything you see there that's got that rusty color is part of the mineralized zone. Down in the foreground of that picture, just for scale purposes, is our camp that hosts, up to sort of 50 people. So, very big footprint here. I think Brian did a great job of kind of laying out the big picture thesis, but this is a porphyry copper district in Canada. It's an established mining district. We own most of the tenements that surround the existing Huckleberry mine. Most of what we're chasing after is significantly bigger in scale. As a result of this being, big porphyry copper deposits, we're exposed to the typical metals that you see coming out of these things: copper, molybdenum, silver, and golds. In our case, in that order. So, all of these metals are going to have their own kind of narrative and story, but I think most people are familiar that. Especially on the base metal side of things, copper and molybdenum both have tremendously favorable long-term supply and demand dynamics, and I think that story has borne out in the price dynamics of both metals over recent years. In the context of BC, I mean, we view ourselves as being in a very premium location. As Bart mentioned, when it comes to base metals, infrastructure is all important. We're in a region of BC that is extremely infrastructure rich. It's an established mining area, so there's power lines and roads in the area, but beyond that, some of the country's largest energy infrastructure, such as the kind of newly built LNG corridor that is being expanded and kind of highlighted by the federal government as part of the nation building projects. This is all kind of 50 kilometers north of where we are. So it's a region of BC that has seen some of the largest private sector investments in the country's history, and as a result has all the kind of key infrastructure that you want to see in terms of power, roads, human capital, access to ports, things of that nature. And then for the investors in the audience, all of you folks, I think the key thing here is the value proposition. So this is a project that is getting quite advanced. We're fully funded to deliver a pre-feasibility on the Berg project next year. The PEA, which I'll speak about in a moment, highlighted very compelling economics. So $2 billion NPV, 20% IRR, both after tax, using long-term copper prices. And on that basis, I'll show you some comparisons against other companies out there. The equity today is very plainly undervalued against those peers. So we see this as a pretty attractive re-rating opportunity as we approach that significant catalyst of delivering the pre-feasibility next year. Why to care about this? What's the context for a project like this? Well, in Canada today, you got several, large primary copper mines. They're all this style. They're all these sort of big porphyry copper deposits, and they all happen to exist here in British Columbia. So the orange bars there on the left are the big operating copper mines here in Canada. Highland Valley, being the flagship one for Teck, is Canada's largest copper mine, followed by Taseko's Gibraltar and so forth. If Berg was in operation today, based on the life of mine average copper production numbers out of our PEA, it would be Canada's second largest copper producer. There's a very significant moly credit. It's a very unique differentiating feature of Berg. The moly to copper grade ratio is quite attractive on a global basis. So the size of that moly credit that would come out of Berg relative to the only other two moly producers in Canada, which are Highland Valley and Gibraltar, would make Berg the largest moly mine in Canada by almost a factor of 10. So we position this with government type stakeholders, real strategic type audiences as a real resilient, potentially resilient supply of moly in the North American context, because there is a history of primary moly mines out there. Freeport operates Climax and Henderson, the two blue bars to the right there. There's other primary moly mines like Thompson Creek and Endako, but they have a long history of sort of turning on and turning off because they don't have the stability of that kind of multi-metal mix. So Berg is a big moly producer underpinned by a substantial copper business. It's not shown on this page, but there's a big silver credit as well. About 3 million ounces of silver could come out of Berg for 30 years, which would place it as a top 5 silver producer in Canada as well. Here's a picture of the district. As I mentioned, lots of important infrastructure around us. The Coastal GasLink pipeline and all the big LNG stuff going on in Canada is just to the north of this map. Rio Tinto has the Kitimat aluminum smelter and Camano power station to the west of us, and the Huckleberry mine, which is on care and maintenance, sits in the middle. I'm not going to talk about our secondary UTSA project too much here, but it is another sizable resource, about 500 million tons in all categories, very comparable grades to what they have at Huckleberry. Huckleberry's been on care and maintenance for 10 years. Its owner, may decide to bring that back online in the future. It's got fairly limited, reserve life. So in the natural course of these things, they may be looking for, satellite feed for that. We think there's a pretty compelling opportunity for UTSA to play that role. If both of these areas of the district were producing at the same time, so Berg, the numbers I just referred to, and Huckleberry at its sort of run rate, this district as a whole would exceed the production levels at Highland Valley. So I think you can piece those two together and consider this as a district play that has the potential to be Canada's largest copper producing region. Just some quick numbers on our 2023 PEA. So billion-ton M&I resource underpinning it. 80% of that is in the measured and indicated category, so quite an advanced sort of resource underpinning all this. $2.1 billion NPV8, 20% after-tax IRR, 200 million pounds per annum copper equivalent production profile. All the numbers here were based on long-term metal prices that we used of $4 per pound copper, $15 per pound moly, $23 per ounce silver, and $1,800 gold. Obviously, all of those prices have moved quite considerably in the last few years. Brian showed some similar math, but this is the compliant stuff that came out of our PEA. So price sensitivities, the red circled numbers were the base case numbers that we announced. If you run the PEA with stuff closer to today's spot prices, you'd be well down into the bottom right corners of the tables that you see on this page. This is a key thing that I probably want to spend the balance of my time on here. So when you look at big copper projects in the world, people like to focus on grade. Obviously, it is I think a proxy for operating margins. Grade tells you a bit about the revenue side of the equation, but I think investors need to. I would encourage investors to focus more on the cost side of the equation. I think what differentiates a lot of development stage projects from one another comes down more to the cost structure than grade differentials. In the case of Berg, it is a very simple project. I think that's part of what makes it shine. Part of it is that proximity to infrastructure I talked about, but part of it is the intrinsic geometry of the project and the deposit itself. The mineralized zone is, as you can see in this image, it's sort of situated in a valley and running up the side of a hill that already has an open pit shape to it, essentially. Over the course of the mine life, a significant portion of the haulage would be downhill or lateral. That obviously drives very efficient mining costs. Material would be crushed and sent further down a hill on an electrically driven conveyor. So again, benefiting from gravity there and benefiting from British Columbia's extremely cheap hydroelectricity. very simple project design. We're not looking at any kind of block cave underground situations. We're not sequencing several different pits. It's just a very, as Brian said, vanilla project. There's some grade enrichment in the top 100 meters, all else equal. That's what you want. It gives you the best cash flows early on to get that payback. Low strip ratio of around 1:1 today, and we see that ultimately coming down as we continue to drill out some of the margins of the deposit as we move forward. So very attractive project all around from its the simplicity side of things. It is one of Canada's largest resource inventories for copper already today. The blue bars are Berg and UTSA combined. The dark bars here are the operating mines in Canada. The light colored ones are the development projects. So some of the ones that are bigger than us today are in these areas of Canada that are, more remote and benefit less than where we do from an infrastructure perspective. So areas deep in the Golden Triangle where there's no roads, there's no power, et cetera. Just some peer comparison. Brian alluded to a detailed table we have in our deck. I'd encourage you to have a peek at that. But just real quickly, we're positioned above the average of our peer group in terms of potential life of mine recoverable copper equivalents. Above average in terms of project NPV, shown on a like-for-like basis. All the numbers here are normalized to $4 copper. But despite that, we trade at a very big discount. So aggregate enterprise value in US dollars around 50 million, so close to 70 Canadian, as Brian alluded to earlier. And on a multiple basis, again, toward the bottom of the peer group. I don't believe there's any fundamental reason for this. It's therein lies the opportunity. More specifically, showing some comparisons against another BC peer at North Isle, another big Canadian peer up in the Yukon at Casino, and Solaris's Warintza project in Ecuador. Lots of numbers on this page, but if you compare these projects on total contained metal, the grade of that total contained metal, the results of economic studies harmonized to $4 copper, prospective high-grade starter pits, et cetera. These things are all very similar, but you see a huge spread in market valuations from ourselves on the low end at a $70 million Canadian enterprise value, all the way up to Solaris at a $1.2 billion enterprise value. So again, therein lies the opportunity. I think there's a lot of inefficiencies in today's market for these types of projects. What are we doing right now? As I mentioned, we're fully funded to deliver a pre-feasibility in early 2026 or the first half of 2026. So a lot of our technical work programs that we've been delivering in recent years are really in service of that. So we've had some pretty material developments around the metallurgical recovery profile for the deposit, some excellent geotech results. We continue to press ahead on resource drilling. We expect to see some improvements in size and definition in the forthcoming resource update, and are preparing to enter this project into the environmental assessment process. So been active doing the usual kind of baseline data gathering, et cetera. In parallel, there does remain a huge amount of exploration potential in this district. It's not a massive focus for us, but we are, I think, prudently advancing a number of high priority targets throughout the district, and we'll likely see some interesting target testing on some of that stuff in the coming year. Just probably concluding here, just on the cap table, very clean cap structure, all common shares, no warrants, obviously no debt. We did a pretty important capital raise this summer. We raised about $10.5 million in July. As part of that financing, our major shareholder, African Rainbow Minerals, ARM, increased their ownership from 15% to 19.9%. They're not a household name here in Canada, but they're one of South Africa's largest diversified mining groups. They operate a lot of big mines ranging from coal to iron ore, manganese, nickel, platinum group metals, et cetera. They don't have any copper mines in their portfolio today. Like many diversified mining groups around the world, they have a favorable view on the metal and are looking for that sort of exposure. They presumably looked at many opportunities and decided to move forward with this one. It's their only strategic investment of this type. So it's a very positive relationship. We've had them on the register for the better part of a year and a half, and are happy to see them increase that ownership. I'll conclude there. Thanks very much. We're out to the right here, so if you have any further questions, please drop by.